So dear friends, we are in MCOM, third semester corporate tax management class. In the previous classes, we have learned about the basic concepts of tax. What is income tax? What is corporate tax? Today, we will come to know about some more concepts relating to corporate tax management. So we are in the first unit of corporate tax management, that is introduction. Okay. This is your syllabus: introduction, corporate taxation, tax planning, financial management decisions, and tax planning, business restructuring and managerial decisions, special tax provisions for certain undertakings, and coming to first chapter. So this we have already discussed, but briefly I will go through them. Taxes, as you all know, are divided mainly basically into two types: direct taxes and indirect taxes. Basic difference is direct taxes are paid directly by the taxpayer himself, or taxpayer means here assessee himself to the government. There are no mediators, there are no brokers. Whereas in indirect tax, just take the case of GST, goods and service tax, there is a mediator, there is a broker on behalf of the assessee, on behalf of the taxpayer, the middleman, the broker will pay the tax. Suppose if we purchase a pen, the shopkeeper will pay tax, whatever tax that is there, that is levied and collected on this pen, he will pay on behalf of us. We will not pay directly to the government. So those taxes are known as indirect taxes. So coming to significance of corporate taxation, these are the valid points which glorify the importance of corporate taxation. This is also covered, but briefly this is important for economic development. Full employment can be achieved. Price stability, price fluctuations can be stopped with the help of corporate taxation. Cyclical fluctuations can be stopped. Balance of payments difficulties can be stopped. Non-revenue objectives like full employment, like national income improvements, several other objectives are there. Those can be achieved. Large scale operations are possible with the help of corporate taxation. Public resources can be utilized in a better way. Whereas government provides certain facilities to corporate bodies, companies in certain cases. So that is why corporate taxation is very, very important. And earnings will be generally more, thousands of crores of rupees will be earned by corporate body, that is a company. So in such a case, they have to maintain proper records. So corporate taxation ensures proper records are maintained by companies. So this is the significance of corporate taxation. Coming to various concepts and definitions of corporate income tax. So basically, fundamentally speaking, corporate is nothing but a company. So unlike a sole trading organization, in sole trading organization, the owner and the manager and director, everything will be all and one, or single person will take care of the proceedings in a sole trading organization. Whereas a corporate is a separate entity and independent entity. Entity means a firm, organization, from its shareholders. Shareholders means the persons who have invested money, who gave money to the company. So corporate organization is separate from its shareholders. So a director's body, managing directors board will take care of corporate organizations, financial operations or managerial operations. Everything will be taken care of by board of directors. They are elected by shareholders. So in income tax, in Indian income tax, domestic as well as foreign companies have to pay tax, have to pay corporate tax. What is Indian company or what is domestic company, what is foreign company, we will come to know in this class itself. Okay. So as per the Income Tax Act pertaining to India, Indian companies as well as foreign companies have to pay, are liable to pay tax, corporate tax to income tax authorities. Okay. Now you see For this purpose, incomes are divided into two categories: Indian income and foreign income. What is foreign income? What is Indian income? Also, we will come to know about that in today's class only. Don't worry. So, Indian companies have to pay tax on Indian income as well as foreign income, whereas foreign companies, they have to pay income tax only on the income earned in India. That you have to remember. Indian company is liable to pay tax on Indian income as well as foreign income, whereas foreign company has to pay tax only on Indian income. What is Indian income? That is incidence of tax. That is also there for you. So, basic difference between Indian company or otherwise domestic company and foreign company is, domestic company is liable to pay tax on its domestic earnings earned in India as well as in foreign countries. Whatever income that is earned by a company, by a domestic company, by an Indian company, it has to pay tax. Whereas foreign company is liable to pay, has to pay tax only on Indian incomes. Okay. So that is the basic difference that you have to understand. Now coming to, so what is profit? On profits, a company has to pay tax. What is profit here? Profit, you have to understand that taxes are paid on companies' operating earnings. Operating earnings means cost of goods sold, COGS, cost of goods sold, and general expenses. These two you have to deduct from revenue. So whatever sales revenue is there, from that one you have to minus cost of goods sold, means in other words production expenses, and general and administration expenses, selling and marketing expenses, advertising expenses or any other selling expenses, research and development expenses, depreciation and other operating costs. All this we have to deduct from sales, deduct from revenue. Whatever income that is received by a company in a financial year, from that income you have to deduct all these costs: cost of goods sold, general administration expenses, selling and marketing expenses, research and development expenses, depreciation and other operating costs. All you have to deduct. And please remember, corporate tax is not the same in every country. It varies, it changes from country to country. In our country, companies have to pay tax, income tax at a flat rate of 30% on their income. They have to pay income tax at the rate of 30%. Companies are liable to pay on their income a flat rate of 30%. So, but please remember, in every country, same tax rate is not there. Some countries are known as tax havens, where income tax rate is very less, very low in those countries for companies. Whereas in India, it is 30%, it is fixed. Okay. So that you have to remember. Now coming to various definitions of corporate taxation. In tax, you have to learn various definitions. This definition you know, assessee. In previous class also I mentioned, assessee means a person who has to pay tax to the government, to the tax authorities, or who has to pay penalty to the tax authorities. Okay. Now, not only that, for a particular person, if any tax refund is also there, suppose he has to pay this year only 10,000 rupees has tax to the government, but mistakenly he has calculated and he has paid 15,000 instead of 10,000. So he has to get a refund of 5,000 from the tax authorities. So in that case also he is known as assessee. Assessee means not only a person who has to pay tax, but for whom certain amount is to be refunded. That person is also known as assessee. If an assessee is a person who has to pay tax to the government, who has paid tax to the government, for whom notices are to be issued from the tax authorities, who is liable to pay penalty. All those persons are known as assessees. Now, another word is there, that is assessee in default. Assessee in default means if a person is unable to pay tax in time, that person is known as assessee in default. Assessee means a person who has to pay tax to the tax authorities, who has to pay penalty, for whom refund will come from the tax authorities. In all those cases, such a person is known as assessee. Assessee in default means he who does not pay tax to the tax authority within time, within specified time, he will be deemed as the assessee in default. Coming to company, in case of company, company is not a physical person. So on behalf of company, certain person, he may be managing director or manager who is in charge of the tax department in that company. He has to take care of payment of tax in time. So assessee company is deemed to be assessee in default. If any principal officer of a domestic company and the company does not pay tax on distributed income, means, see, you all know, on shareholders will have to be paid dividend from the profits of the company. From the distributable profits of the company, they have to be paid dividend. Shareholders will receive dividend. So in such a, this is known as distributed income. So the person who is responsible, principal officer who is responsible in a company, who does not pay tax on distributed income in accordance with the provisions of section 115 QA, then he or she is deemed to be an assessee in default. So in case of companies, the person, principal officer responsible to pay tax on the distributed income to the tax authorities, then such a person is known as, under provisions of section 115 QA, he is known as assessee in default. Okay. So as a punishment, he will have to pay a fine. If the amount is more, he will be paying more fine, and sometimes he may be put in jail. That he has to remember. Okay. Now coming to some more concepts. See, consequences. These are dangers. See, a failure to deduct pay. Sometimes, see, before paying the dividend to a shareholders, the income tax manager who is taking care of in the company, he has to deduct the tax from the shareholders before paying them dividend. So if he does not deduct the tax amount, so he is liable to pay that amount to the government. That he has to remember. Okay. Now, see, these are the subsequent provisions relating to assessee in default. Okay. The assessing officer will check who is responsible for not paying tax from the particular company. Okay. So if he is unable to pay, the officer who is responsible to pay tax in the company is unable to deduct tax revenue and repay it to the government, to the tax authorities, then he will be punished. He has to pay that amount to the tax authorities. So in such a case, in a single amount, the tax authorities will collect, or sometimes they will collect in installments from the person responsible. So that is what is mentioned in Income Tax Act. Okay. So in such a case, the assessing officer, income tax officer will send a notice to the person who is responsible to pay tax in the company. So he will see to it that the person responsible responds to the notice. So if the concerned person does not respond to the notice of the assessing officer, of the income tax officer, then he is liable to be punished under the Income Tax Act. So that is why all care should be taken from the officer in the company to see to it that the company pays tax in time. Otherwise, he is punishable. That he has to remember. So these are the concepts relating to assessee in default with reference to company. Okay. Now coming to financial year, this concept you know at your degree level, at your UG level itself, but now again I am explaining you. A financial year starts from 1st April and it ends at 31st March. With every year, 1st April, the financial year will begin and it will end on 31st March of the next calendar year. Now let us take, for example, we are in 2021 calendar year. This is calendar year. Means calendar year we will say from January to December. So now coming to what is financial year. See, this we are in January of 2021. So it's corresponding to this 2021 first in April 1st 2020 to March 31st 31/3/2021. This financial year is going to be there for 2021 January month. I hope you understood. The financial year will begin from 1st April to it will end on next calendar year's 31st March. So now we are in January 2021. So our financial year for this January 2021 is April 1st 2022. It will end on 31st March 2021. So whatever earnings that a person earns, that an assessee earns during this financial year, he is liable to pay tax in the next financial year. That is known as assessment year to this financial year, to the previous year. This is also known as previous year to the next assessment year. So in order to make it clear to you, I have given a table for examples. You can check what is financial year, what is assessment year, you can see. So these, I hope this will make it very clear to you. See, from 1st April 2019 to 31st March 2020, financial year is 2019-20. Its assessment year is 2020-21. Means 2020-21 means it is 1/4/2022, 31/3/2021. 1/4/2022, 31/3/2021. Now 1st April 2018 to 31st March 2019. For this financial year is 2018-19. Its assessment year is next year 2019-20. Similarly, 17-18 financial year is 17-18 means April 2017 to March 18. Its assessment year is April 2018 to March 2019. Similarly, another example we can see 1st April 2016 to 31st March 2017. Its financial year is 1st April 2016 to 31st March 2017. Whereas its assessment year is 1st April 2017 to 31st March 2018. So this is financial year is otherwise this is also known as previous year. Previous year for this assessment year. See, for 2020-21 assessment year, this is previous year. For 2019-20 assessment year, 18-19 is previous year. For 18-19 assessment year, 17-18 is previous year. Similarly, for 17-18, 16-17 is the previous year. So whatever income that a person, that an assessee earns during 2019-20, he has to pay tax on such income during this period. And likewise, it holds good for the remaining financial year and assessment years. I hope you understood. Now coming to residential status of a company. So based on residential status, at your degree level, you must have heard about three kinds of residential status of individuals. Resident individual, non-resident individual, partially resident. Likewise, three divisions are there. Resident but not fully resident. Likewise, classification is there in case of individuals. But in case of companies, based on its incorporation, based on where a company is registered, or on the basis of control and management of its affairs, means from where the company is being controlled, on the basis of these two bases, company is divided into two categories: resident company and non-resident company. Means otherwise, domestic company and a foreign company. In other words, domestic means resident, non-domestic or non-resident means foreign company. Simply speaking, if a company is registered in India under Indian Companies Act 1956, it is an Indian company. Similarly, if a company is control and management is from India only, means board of directors are in India, are residents of India, then that company is deemed to be a resident company. When non-resident company means all those companies which are non-resident companies, which are not registered in India, as well as whose affairs are not managed from India, from the land of India, from the soil of India. Those companies are known as non-resident companies. Means they are registered elsewhere in foreign countries, whereas their management, their control, everything is in foreign country. Then that country is known as a non-resident company. Okay. Now coming to next concepts. So why it is important, why it is relevant? So it really matters. So this is, in other words, known as tax incidence. Tax incidence means who has to pay tax to the government. That will be determined by residential status. So that is known as tax incidence. Means who has to pay tax, that will be determined. Okay. Normally speaking, this holds good for individuals. Let us just go through it, whether taxable or not. Income received, see, Indian income or foreign income, both are taxable for Indian company. Whereas, simply speaking, if it is a foreign company, only foreign companies, they will pay tax on only Indian incomes. That's all. In foreign incomes, on foreign incomes, they are not liable to pay tax. At the beginning of this class, I mentioned, see, companies based on their this is for individuals. Okay, but we are in corporate taxation. But for your revision, I mentioned this table. But remember, so Indian income. What is Indian income means? Indian income means the income which is earned in India. Similarly, the income which is deemed to be arisen in India, accrued in India, that is Indian income. Whereas foreign income which is received in foreign country, which accrues in foreign country, which is deemed to be arised in foreign country, those incomes are foreign incomes. So based on residential status, we have categorized companies into Indian company, foreign company, or domestic company, foreign company. So Indian companies will pay tax on Indian incomes as well as foreign incomes, whereas foreign company is liable to pay tax only on Indian income. That concept is known as tax incidence. In simple terms, tax incidence means based on residential status of an assessee, who has to pay tax and from which incomes they have to pay tax will be determined in tax incidence. That is what you mean by saying tax incidence. Okay, I hope you understood. Now coming to Indian income and foreign income. I mentioned already this. See, whether income is received in India during the relevant year, yes, it is Indian income. You can see. Whether income is received in India during the relevant year, no. Whether income is received or deemed to be received in India during the relevant year, it is Indian income, yes. It is Indian income, yes. It is Indian income, no. It is Indian income. Foreign income, no. Whether income accrues in India during the relevant year, yes, it is yes. Whether income accrues in India during the relevant year, no. Status of the income, these are the statuses of the income that you have to remember. One holds good for domestic company and the other one holds good for foreign company, that you have to remember. So whether income accrues in India during the relevant year, yes, it will be treated as Indian income. You have to pay tax for foreign company. Whether income accrues in India during the relevant year, no, it is foreign income. So status of income is divided based on their receivability and there are otherwise their whether they accrue or not, accrued in India during the relevant year or not. So that in that way you have to understand. Okay. Now coming to Indian income. So this concept I made it clear to you. Indian income is always taxable in India, irrespective of the residential status of the taxpayer. Indian income. So whether you are a domestic company or a foreign company, if it is Indian income, you have to pay tax, irrespective of the residential status of the taxpayer. Whether you are a resident company or a foreign company, it is immaterial. If it is Indian income means you have to pay tax. Now foreign income, you can see foreign income is taxable in the hands of resident and ordinarily resident in India, means this holds good for individual, but we are saying it as domestic company, that's all. Domestic and ordinarily domestic, likewise we are not categorizing, simply domestic company. So a domestic company is liable to pay tax on foreign income also, whereas it is not taxable in the hands of a foreign company. Okay, so this is what you mean by saying tax incidence. Tax incidence means the liability to pay tax, it will be determined in tax incidence. Remember, you have to remember two things: Indian income and foreign income. Indian company, foreign company. So Indian company is liable to pay tax on Indian incomes as well as foreign incomes, whereas a foreign company is liable to pay tax only on Indian incomes. Then the question again, which is Indian company, which is foreign company, which is domestic company, which is foreign company? Indian company is that company which is either registered in India or is controlled in India, whereas foreign company is not registered in India or not controlled in India. So that you have to remember. Now coming to types of companies under Income Tax Act. So companies are divided into these categories based on their nature or where they are situated, how they are controlled, with which they are doing a business, whether public is interested or not. So based on all such, companies are divided under these categories in Indian Income Tax Act. So what are the categories? About them we will come to know deeply into next class. So under companies, under Income Tax Act, companies are divided as company, a company in which the public are substantially interested, a widely held company, closely held company, Indian company, domestic company, foreign company, investment company, and based on residence of a company also, companies are divided. So these are the categorizations of various companies under Income Tax Act. I hope you understood. So dear students, dear friends, what we have learned today? We have learned about various concepts of corporate income tax, that is domestic company, foreign company, assessee, the deemed to be assessee in default, deemed to be default. What are the punishments that we have come to know? What is financial year, what is previous year, what is assessment year, we came to know. Residential status of a company, how it is determined, we came to know. And incidence of tax, we came to know about them. And what are the various types of companies under Income Tax Act, we came to know about this. And tomorrow I will explain, in our next class I will explain in detail about the various types of companies under Income Tax Act. So thank you very much, dear friends.